Back in the glory days of global capital flows, emerging markets could raise billions by issuing nice, simple bonds that promised a fixed return over a set number of years. Investors around the world gobbled them up, eager for the higher yields on offer compared to the glacial interest rates back home. But those debt jubilees went into eclipse after a cascade of defaults during the pandemic-era losses exposed the risks. With skittish investors now demanding risk-free returns approaching the giddy levels of year 2000 tech stocks, the dicey sovereign debt market has become a nuclear wasteland, financially radioactive for all but the most reckless funds. Restoring vibrancy to this market is more than an academic exercise. Without reasonably priced access to capital, ambitious developing nations will remain stuck in subsistence stagnation, their people's aspirations forever deferred. Which is what makes the debt restructuring currently being negotiated in Sri Lanka so fascinating. In exchange for a hefty haircut, the bankrupt island nation is proposing to replace a chunk of its defaulted bonds with a newfangled variety whose payouts would rise and fall based on the country's economic performance. Call them macro-linked bonds, securities whose fluctuating returns are tethered to metrics like GDP growth instead of a fixed coupon rate. It's an iconoclastic idea that investor advocates have dreamed of for decades as a way to craft more productive, reality-based debt contracts. After all, the traditional bond format made zero sense for a country experiencing roller-coaster growth swings. Why commit to pay, say, 6% interest during a boom while reneging on that same obligation during downturns? A callow financial kindergartner could detect the logical inconsistency. The innovation proposed by Sri Lanka's creditors, which includes converting $9 billion in defaulted debt into new GDP warrants, would recalibrate the payout ratios every 5 years based on actual growth data. So if the economy expands rapidly, yielding an average $90 billion in annual dollar-based GDP over that span, creditors would see a 25% markup in what they're owed. But if fortunes turn grim and output averages just $78 billion, another haircut of over 1/3 would be automatically triggered. Crucially, because the variable payouts would be directly stipulated as part of the bond's contractual terms rather than a messy add-on option, the newfangled securities could realistically be included in the major emerging market debt indices that investors worldwide use as performance benchmarks. That alone could unlock trillions in fresh capital flows from pension funds, sovereign wealth funds, and other institutional investors currently barred from indulging in today's high-yield, high-risk market for the risky fringe assets of countries like Sri Lanka. A second part of the proposal could link another chunk of remaining defaulted debt to governance indicators like anti-corruption reforms and improving tax collection. The symbolism has moral potency. By explicitly tying the coupon rate to concrete measures of administrative efficiency, investors could rest assured that whatever painful debt restructuring concessions they swallowed wouldn't be squandered through graft-gutted misrule. In an era of disruptive financial technologies, the Sri Lankan experiment is part of a broader reinvention of debt markets to reflect modern economic realities. It's all about better aligning incentives for borrowers and lenders by junking the simplistic notion that a country's ability to service its debts remains static across booms and busts. With major asset managers like BlackRock openly cheering the proposal, macro-linked bonds could catalyze a virtuous circle of capital inflows funding governance reforms and productive investments that in turn generate the robust growth needed to attract even more investors. Of course, avant-garde financial products often encounter skepticism, given the market's traumatic history with GDP warrants and other whiz-bang innovations that inevitably blow up somehow. There are also understandable doubts about the reliability of growth metrics in many developing nations. But such objections have an unfortunate odor of yesterday's thinking, the myopic, amortization schedule-worshipping mindset of rigid lenders demanding their pound of flesh regardless of circumstances. That regressive model has plainly run its course, consigning entire generations across the global south into perpetual debt traps, development denials, and dehumanizing destitution. The real gamble is preserving a debt financing system transparently ill-suited for an era of multiplying economic shocks from climate change, technological disruption, and geopolitical realignments. If we're intellectually honest, the true risk lies in clinging to the moribund conventions that created our current global disorder. For too long, the international financial community has lacked the moral courage to overhaul an antiquated debt architecture that systematically immiserates the masses. The enlightened path pioneered by Sri Lanka and its inventive creditors points a way forward to a long-overdue reinvention of how capital gets conscripted in service of human flourishing. Next year marks the 80th anniversary of the Bretton Woods system's establishment, the US-led financial architecture that rebuilt the war-ravaged world. Perhaps this modest debt restructuring, with its common-sense rationality, can mark a first small step toward a sorely needed renaissance in international finance for the 21st century.